4 things Gen Zs can learn from Charlie Munger, top investor. Hey guys, today we're going to list 4 things Gen Zs can learn from Charlie Munger. Let's get right into it. Number 1. Buy shares like you're buying the business. Approach any valuation as if you were buying the company privately. As a grain value investor, a methodology that Charlie subscribes to, you try to understand the asset's value. If you don't fully understand the company's business model, you can't understand the security's value, so it's best to avoid the investment. When conducting research, it is critical that you consider more than just the current share price. Examine the overall cost of the company. The cost of purchasing the entire corporation is referred to as market capitalization, or market cap for short. It is the total value of the company's outstanding stock shares, including restricted and publicly traded shares. Divide the total number of shares by the current stock price. When debt is added to the corporation's value, it is referred to as its enterprise value. In a nutshell, the market capitalization is the sum of the prices of all outstanding shares of common stock multiplied by the quoted price per share at any given time. The size of the company in which you are interested in investing has a significant impact on the amount of risk that you're willing to take when purchasing a stock. Before purchasing a stock, consider the company's size in relation to your risk tolerance and time horizon. Number 2. Create a margin of safety by buying at a discount. To protect your investment from human error, misfortune, or extreme volatility, buy a stock at a market price that is less than its intrinsic value. The intrinsic value represents the present value of future cash flows, also known as the margin of safety. Margin of safety is an investing principle that states that an investor should only buy securities when their market price is significantly lower than their intrinsic value. In other words, the margin of safety is the difference between the market price of a security and your estimate of its intrinsic value. Because investors can set their own margin of safety based on their risk tolerance, purchasing securities when this difference exists allows for a low-risk investment. In accounting, the margin of safety, also known as the safety margin, is the difference between actual and break-even sales. Managers can use the margin of safety to determine how far sales can fall before the company or project becomes unprofitable. The margin of safety is a financial metric that equals the difference between current or forecasted sales and sales at the break-even point. The margin of safety is sometimes reported as a ratio, which is calculated by dividing the aforementioned formula by current or forecasted sales to yield a percentage value. Buying at a discount increases your chances of success. Number 3. Make Mr. Market your servant, not your master. With his short-term volatile nature, Mr. Market is a metaphor for the capital market. In March 1989, as the stock market soared, Buffett wrote, "We have no idea how long the excess will last, nor do we know what will change the attitudes of the government, lender and buyer that fuel them. But we know that the less prudence with which others conduct their affairs, the greater the prudence with which we should conduct our own affairs. It will sometimes sell securities at a loss during the depressed phase, and it will exaggerate what a stock is worth during the euphoric phase. If a firm's fundamental value remains constant, Mr. Market's short-term views can be tolerated because they will be corrected in the long run." Number 4. Be rational, objective, and dispassionate. It might be easy to underestimate how important rationality is to a grain value investor, but it is our main protection against making emotional errors and thereby significantly contributes to the investor's success. A value investor determines a company's intrinsic value and only invests when that value significantly exceeds the company's market price. The price-to-value differential, also known as the margin of safety, protects an investor from unforeseen events and allows him or her to achieve excess returns in the absence of such events. All other things being equal, the more mispriced opportunities an investor can find, and the greater their mispricing, the better. A rational investor constructs a portfolio of the best opportunities available, utilizing his multidisciplinary knowledge and rationality tools while attempting to avoid the numerous pitfalls that make achieving reasonable results so difficult. You should also understand the investment objective. An individual's investment objective, which is typically based on one of 4 strategies that include income, growth, and income, growth, or trading, clarifies investment ideas to help achieve an individual's financial goals. Individuals may provide information such as annual income and net worth, average annual expenses, timeline for withdrawing funds, and the maximum decrease in the value of the portfolio with which the investor is comfortable. The portfolio is tailored based on the answers to these questions, and a strategy is defined as an investment goal. You should also become a dispassionate investor. Concern when a stock's value falls and euphoria when it rises are both natural human emotions, even if they may be pointing in the wrong direction. A dispassionate advisor, with little emotional attachment to the stock's daily movements, would do far better to assess what is intrinsically good or bad about it. To summarize, an individual investor must be intelligent while remaining emotionally detached from the stock he is buying or selling. He will do well if he can tolerate losses by holding or selling, but he will do poorly if he is only concerned with making profits at all times. Being intelligent may not be enough to make you a great investor. That's all for today, and we'll be sure to catch you all in the next one.